For those that are here in the classroom, how many of you have been to our events before? Cool, cool. Anyone here for the first time? Awesome. Well, thank you for joining. We do our classes. We used to do them every Tuesday, every Saturday, sometimes on Thursdays, and we're kind of rotating them now. We do this Lunch and Learn every second Thursday of the month, and we also have a social that we do, which is the second Tuesday of the month, but I'll talk about that one in a little bit. But welcome. We're glad to have everyone here. Appreciate everyone having a seat right here in the middle for us. And for those online, we're going to go ahead and get started. So today you are here at the Austin Lunch and Learn. We have James Kandasamy, who's going to be our guest speaker today. But before I bring him up, I'm going to run through just a couple of quick announcements. You may have already heard them, some new ones that we have, but I'll make it pretty brief so we can jump into the meat and potatoes of today. But like I mentioned, we have educational resources all across our platforms, whether that be in the way of blogs or articles, pre-recorded classes. We have events that are educational, some that are networking, some that are a little bit of both. So no matter what you're looking for, we definitely have something for you. And then again, all of the educational events that we do put on, those will be live streamed as well. So you can go back, watch the class. If you have a friend or you know somebody that might benefit from the class, you can send it to them as well. So they're really good resources for you as you continue learning and self-directing. This is the Masters of Tax Avoidance Bootcamp that we have coming up. And I'm really happy to announce, because I just finished finalizing our speaker lineup, and we have a great lineup for you guys. So I am bringing about 6 brand new faces to our Quest platforms that you've never seen before. They're all brand new speakers, some people that we've been meeting and connecting with. We've got some new attorneys, we've got a couple of new CPAs, some new experts in the private asset field. I mean passive investment field, sorry about that. So very excited for that one. This one's gonna be in Houston, but for clients and for those here today, I have a 50% off coupon for you. So if you want to get more information for that, come see me afterwards. I'll be here until I head out for lunch, but we can get you signed up for that. Or Juan, who's in the back, and then Megan as well. You may have seen her walking around, but any of us will be able to help you out. This is, it's Quest Cares Month. So February, we are giving back. So what we're going to be doing for the whole month of February is we are going to be not only donating to some charities, but we will also be giving gift cards for those that maybe want to get their account started this month. So if you choose to open an account, you will be put into a drawing to win a $500 Airbnb gift card. So take a trip on Quest, spread the love. Maybe you want to go and have a little getaway with your loved one. You can do that with our promo this month. And then, as always, if you know somebody that might benefit from a self-directed IRA, refer them to Quest, and you will get a credit towards your account if you have one, but it'll also benefit them as well. It'll save them some money too, so you will each both get a benefit there. And then if you do have any questions, whether that be about the events that we put on, self-directed IRAs, private investing, whatever it may be, we can probably help. We're here to be a resource for you. And if it's something that we can't help you with, we can definitely get you to the right person or make sure that there's something that we can do to at least point you in the right direction. So either give us a call, you can come to our website, questtrustcompany.com. We've got a live chat feature there. Or you can shoot us an email, IRA specialists or marketing at questtrust.com, and we'll be able to help you out. Last thing is this QR code right here. If you want to scan it, takes you actually directly to our Calendly page. You don't even have to send us an email or call us. You can just pick what time works for you and get that consultation scheduled. It doesn't have to be about new accounts. It could really even just be, you have an account with us, start of 2023, you've got a couple account questions, maybe maintenance questions, want to make sure you're all good to go. You can just call us, chat, make sure everything's okay. Like I said, we're here to be a resource. We're your IRA specialist in a back pocket. So without further ado, I'm going to bring up James. So he is an expert when it comes to passive investing, which is one thing that we've really been trying to do a lot of education on recently. And his focus is, of course, in multifamily. So let's give him a big round of applause. And for everyone online, let's welcome James.
Okay. 1, 2, 3. Awesome. Hi, I'm James Kandasamy. Thanks for coming for today's presentation. And for the people online, I don't know where you guys are. You probably need to look at the camera, I guess, right? Thanks for joining me here. And I think it's going to be a fun networking at the same time learning session today. I want to really make sure it's educational because we like to really add value to a lot of people. And one way to build trust and friendship and network is all by adding value, right? So I'm a big believer in adding value, and I'm also an author of the book, which I'm going to be talking in a short while. So let me see whether this works or not. All right, a disclaimer is all investment I've raised. This is more of an educational session. We're not offering any advice on passive investing or investing. Please consult your CPA, attorney, and financial advisor for any investment decision. I'm not an expert in IRA. There's a lot of experts here in IRA. I have a lot of investors. We have almost 500 investors with us. A lot of them use IRA to invest, and they're very happy. And a lot of opinion that I'm going to be explaining in this educational session is more of me being an operator or a deal sponsor, right? So I focus a lot on acquisition and investor relation, and my wife Shanti, she focuses a lot on property and construction management. So if we are deal sponsors or operators focusing in Austin and San Antonio, right? We have more than 500, almost $500 million assets under management, almost 3,700 units, 19 apartments, even though we sold 6 assets March of 2022, which was really good timing, perfect timing, right? We have almost 400 investors. We also have 150 million in construction, commercial construction, right? And AUO is something new. It's assets under 100% ownership, I would say. So we have almost 300 units assets under ownership, but its values are almost $30 million, right? Some of it's under construction, some of it's under, we already own it. So that's an awesome numbers in terms of owning real estate. And we are based out of Austin here. Our office is in Research Boulevard. We're also vertically integrated. So vertically integrated, what it means by vertically integrated, so we own the real estate. We also work directly in raising money from investors. At the same time, we also own our own property management, which is big because in real estate, you want to control the whole thing. If you give it to third party, you can definitely do that. You do less work, but you lose a lot of control. And some of the projects that we do is difficult projects, right? So we are very happy to be vertically integrated. I'm also author of a best-selling book. This numbers is sold more than 2,000 copies. Actually, we have sold more than 5,000 copies right now, which is an awesome. And if you go to Amazon, you'll see this book. There's like 115 5-star reviews, which is awesome. And the book is in the back. If you go to Amazon and buy it, it's going to be like $20. But here we're having it for like $10. Just grab if you can. And if you want me to sign for it, just let me know. I'll sign it for you guys. And we also have a podcast, Achieve Wealth Podcast, which is almost 120 episodes right now. We have a YouTube channel. You guys can see me a lot in these 2 places. At the same time, we have almost 18,000 members. Facebook group. It's called Multifamily Investors Group, which is, you can see a lot of me there, right, in that Facebook group. So that's in general, what do we do and what are the things that we manage, and how to see more of me and my team, right? So this is our org chart where we have Achieve companies. We have, if you see over here, there's Achieve Investment Group, which does a lot of asset management. We have Achieve Properties, which does property management. We also have a small GC, general contracting, for our own deals. We also have an education division, which focuses a lot on passive investing or passive investors education. Achieve Cares is our 501c3. We have like 448 kids right now, which we're sponsoring across 8 countries. This is Africa, India, Mexico, Philippines. There's 3 other countries also in Africa, which we sponsor. And we also have Achieve Development, which is our ground-up construction project division. We have almost 45 employees working for us until now. So our focus in real estate spectrum, right? So real estate has 7 spectrum, right? I'm sure a lot of you have heard about value add, right? How many people are passive investors here? Can you raise your hand? Okay, anybody doing active? Awesome. All right, good. So we have a mix of active and passive, which is good. So a lot of people talk about value add, right? But they don't talk about the other things. A lot of people don't talk about land banking. A lot of people don't talk about land packaging, land development, building operation, building renovation. So value add is here, building renovation. And we have a property redevelopment, right? A lot of gurus teach this because that's what their guru taught. But a lot of people don't teach the entire spectrum, right? So Achieve, like me and my team, we focus from spectrum number 2 right now. Spectrum number 3, 4, 5, 6 is where we are focusing right now. And the reason why we are focusing on other spectrum is because first of all, not many people knows that spectrum. Second of all is, with market cycle, the spectrum of where you make the most money changes. You can't be doing value add all the time, right? Because when price is too high, your value add is eaten up by the price. That's what happened in 2022, right? A lot of people, 2021, 2020 price was so high up, now a lot of people can't even pay distribution because they paid too much, they got low interest, but the interest rate went up, now they got no cash flow, right? So you can't, we are a strong believer of playing the other spectrum, but playing the other spectrum also comes with higher risk, right? Investment is all about risk. And if you understand risk, you can always manage the risk and manage your expectation of return. So this is where we play a lot, which is on the 4 spectrum. And there's a lot more details to all this. You guys can ask me questions after that, or you can stop me while I present. So I'm okay to stop and answer. So let me know if you have any questions as we move forward the slides. So these are some of the projects that we're doing. We have 324 units which broke ground 4 months ago. This is in San Antonio. This is a property we're doing it ourselves. There's not even investors in this. This is just our company doing this. So that's one big development we're doing. We have another 300 something in San Antonio as well. We have another 300 something that we are working in San Marcos. We have another 700 units we are working in Elgin, which I didn't really put because all that is under development in Manor. And we have another 300 units in Taylor, Texas, which is opposite the Samsung factory. You guys see here? This is Samsung, and this is our site, just opposite Samsung. So we have another 300 units. We're also building another 150 units in Round Rock, which is more of a BTR. And we also have we were working on Anderson Mill over here. So Anderson Mill is just near to 183 and Anderson Mill. So we have a lot more projects than this. They just can't put everything here, right? But it's just a snippet of what we do. So these are some of the existing assets. I just need to, as I said, we sold one in 2019, and after that we sold 6 assets. I know we didn't put in all the numbers here. We sold 6 assets here, and average return of almost 30 to 40% per annum on all of this. IRR would be more than 30%, right? We basically made 6 passive investors millionaires last year when we sold, right? So that's crazy, right? Imagine this. If you're a passive investor, you give us 100, 200,000 for 6 assets and didn't do anything, and 3 years later you get $1 million. Passive investing is a beautiful thing, right? Sometimes everybody looked at all this and they want to be active. Active is a lot of work. It's a lot of work, a lot of risk, a lot of gray hair. You get older faster. Passive investors, they are happy and they go and have fun, and if you choose the right horse, it's not everything, okay? Passive, that's what I'm going to be talking about. You have to really know who are you investing, and there's a few other factors that you really want to see. They can make you really rich if you invest with the right guys or girls. Okay, so let me go a bit more detail into passive investing in commercial real estate, and we can go into how we can use self-directed IRA or solo 401k, since this is hosted by Quest IRA, right? What is passive investing, right? It's fundamentally a company structure where you have a deal sponsor and a passive investor, right? So what is this different with a JV structure? Anybody can answer with a JV structure? It's different. Sometimes people have, 10 people, everybody has 250,000 each, and they said, why not we just buy ourselves, 10 people? Why you need LP, GP structure? Why not? Anybody knows what's the difference between JV and syndication? Say that again? Material participation, yeah. If you have 20 people or 10 people, everybody will participate. Otherwise, you're violating SEC rule, right? I mean, I'm not an expert, I'm not an attorney, but this is just my opinion. But on a syndication, there's a deal sponsor and there's a passive investors, clearly separated, right? The deal sponsor are the one who's doing the work, right? They find the property, they obtain financing, they sign on the loan, they raise capital, and they manage the investment as an asset manager. Whereas passive investor in syndication, they basically provide funding to be part of the equity and receive cash flow, right? So that's the difference in passive investing and syndication, right? If you're doing a JV, you're not really doing passive investing. Who can be passive investors? Two popular SEC regulations, 506B and 506C. And 506B is basically pre-existing relationship with sponsors, maximum 35 investors, sophisticated investors, but unlimited accredited. Whereas 506C is only accredited investors and we can advertise, right? And what's the difference between these two is if you're accredited, you need to have a more than 1 million of net worth without including your primary residence or earning 200,000 or 300,000 for past 2 years, right? So that's the basic general description of accredited investors. Okay, so this is something that I added in, and I want to talk about this a bit more detail, right? So sequence of priorities to select a deal to invest in. First, of course, is always the operator, right? Who's the jockey, right? So if you select the wrong operator, a good deal can become a bad deal, right? Right? And this is what I've said in my book. A good operator can take a bad deal and make it a good deal, and then a bad operator can take a really good deal and make it bad, right? And we have seen it. I've seen it multiple times in my time as a real estate investor. The second part, which I don't really talk about, but I've started emphasizing now. I mean, previously people said operator, the deal, and the market, right? People always talk about that. Everybody talks about that, but everybody forgot about the investment structure. This is very key. And when I wrote the book, I didn't even know about this. But after I wrote the book, I said, when I start looking, because when I was writing my book, I've raised like $30-50 million at that time on my own, and I was doing my own deals. I never even look at other people's deals. I've never been a passive. But after I wrote the book, I started looking at what's everybody else doing. I started looking at everybody else's deals. And when I read their PPM, oh my God, I was like, they are really structuring the deal, a lot of them, not as friendly to passive. They're putting a lot of risk on passive, right? But a lot of people do not know this, right? How many people have really read the PPM, right? But PPM is so legal mumbo jumbo. When you read it once, you really don't get it. You have to read it multiple times, and you really have to transfer that into a investment methodology in terms of what is your risk to it, right? I mean, which I didn't mention, I'm an electrical engineer, an MBA, and also a CCIM. So CCIM is very, very reputable accreditation in commercial real estate, and we have to hold certain accountability to whatever we communicate, right? So we are very particular about the investment structure. So when I look at the investment structure out there, it's not very passive friendly, right? So for example, there was one syndicator where I said, oh, I'm going to be doing 70-30 split, 70-30 split, 70-30 split. Right? Say it very quickly, right? It's normal, right? 70-30 split, but he said 70 for him. If you read in PPM very quickly, you don't really see it, right? And that investor, let me tell you, it was so popular in Facebook. Everybody loved him. Every time he posts, everybody, yeah, awesome, good job. I have 4,000 units. But so the way they structured it is they said, okay, I'm going to give you 10% pref, and after I refinance, you're still going to own 30%. I'm going to give you 100% of your money, but you're going to own 30%. Have you all heard about that structure? Oh, but it's an awesome idea, right? I'm giving 10% pref from day one. 10% from day one. And he's doing a deep value add, a deal where it doesn't have any money. So first of all, how is he giving 10% pref? Nobody really asks about it because every passive investor is just happy they're getting 10% pref, right? And he said, after I'm going to give you refinance in 2 years, I'm going to give you back all your money back, and you're still going to own 30% of the deal. So it sounds really good. Oh, I'm going to get 10% from day one. I'm going to get 100% in 2 years, and I'm going to own 30%. It looks really awesome, right? Then I said, there's no way to do it because there's depreciation, there's tax consequences, a lot of things that doesn't play right. Then when I look at the PPM, I said, oh, 70% to him. 10%, he just overraised it and he put it into a different account and start paying, right? But nobody questions all this because passive investors are so happy getting money. They say, when is your next deal? That's the question passive investors are going to be asking. When is my next deal? Oh, you're giving me 10%, but nobody thinks about how is he paying 10%, right? And one of that operator right now got SEC complaint because he got no more money to roll. He did so much of deep value add, he'd give 10% and you don't have money, right? So now he's in trouble, right? But there's another guy who's still doing it and he's not in trouble. But a lot of people are still investing in it. But a lot of passive investors doesn't know about the investment structure, right? Nobody really reads it, right? Because as I said, PPM 70-30 looks very common, right? But if you read it properly, 70%. That's how you can give 30% after refinance because the bonus, not say bonus, but the depreciation calculation has to be based on the ownership. So if the passive investor only owns 30%, you can still get 30% ownership at the end. So that's how the game is being played. That's one game, right? There's another game called 80-20. Everybody knows 80-20 profit split? It's very common, right? But let me tell you, 80-20, there's many ways it can be manipulated, right? Do you want me to tell you the secret? Because I'm sure everybody invested 80-20 deal, right? But you could probably okay, right? Because as I said, a lot of sponsors do that, but there are also sponsors who does the normal things, right? So 80-20 can be two ways to be manipulated. One is if they give you 80-20 from day one, they take 20% off. That means today you buy a deal for 10 million, tomorrow you sell it, your 20% is already gone. Only 80% is given to you. So from day one, they take the equity. Still sounds normal, right? 80-20, right? But nobody does during the normal market time. You don't see it because usually it goes more than 100% of return. But when the economy is down, or when the prices are going down, now you'll see, hey, where's my money? Oh no, I took 20% from day one. You have to make 80% plus another 20% to even break even, correct? So that's another secret, right? So now I'm sure everybody got to go back and look at their PPM tonight. Whenever I talk about this, everybody calls me, James, I looked at my 10 PPM. 7 of it is like that. I said, well, I cannot do anything. You didn't read my book. Everybody thinks that they know passive investing. People have read my book after 15 deals. I wish I've seen this book when I started. Because people think passive investing is normal. There's too much of FOMO. You know what's FOMO? Fear of missing out. You see all these guys are passive. When you go to conference, there's guru selling you membership for 20,000. You see everybody's running, oh, I want to invest. And then everybody close eye and throw money, right? Nobody really reads the investment structure, right? Let me tell you another secret about 80-20. 80-20 can be from your capital, whatever. So let's say you're investing in 5-year deal, right? You're getting 10%, 10%, 10%, 10%. Happy, right? Everybody's happy? But the 10%, if the structure says that 10% is your capital, will you be happy? No, right? Because it makes a big difference if that is your capital versus profit. Do you want to go and give a CD for 5% at the bank, and the bank said, I'm going to give you back your capital. I'm not going to give you profit. Nobody wants that, right? People want profit on top of your money. If you put 100,000, you want profit on top of it, not pay me back. They said only at the back end, I'm going to give us profit split. So what they do is, let's say you do a 10%, 10%, 10%. For 5 years, you already got 50% off your capital. So when they split at the end, 80-20, they are splitting on a bigger pie. Does that make sense? Yeah, I have an online course which talks about all that because you need to visualize all this, right? And as I said, PPM, when you read the PPM, you really don't get it because it's all written in legal mumbo jumbo. Unless someone like me explain in a layman term, which a lot of people don't even able to explain because they're not that sophisticated. Yes, question?
So the first example you gave where the 80-20 can be incorrectly done was where it should be is until I get 100% of my
Exactly.
original basis back.
Correct.
Then only you start splitting.
Correct. Yeah. It's always be on top of your capital, right? But if they take your capital from day one, that means they're basically charging a fee of 20% from day one. Oh, okay. So the question that, what's her name, sir? Rosh asked was the first example was 80-20, right, on the equity split. The first example I gave where they take money 20% from day one itself. The right way to structure it is to give back the 100% of your capital back. Then you do the profit split on top of that, right? That means your capital is always preserved, correct? So the second example is also the same. You should be preserving the 100% of your capital, then you split on top of it, right? But if your investment structure or PPM is written as though what they say is, I'm going to give you back your capital. Whatever operation cash flow that's coming in is considered capital. Then every 10% that's given cash flow is basically your capital is being reduced. So how much money you are making for 5 years if your capital is being reduced? You're making zero, right? You're not making any profit. If you're getting back your capital, you're just giving back my capital, right? So, but as I said, passive investors are not very well versed in this. They're happy because you're using 10%. The question for them is, when's your next deal, right? When's your next deal? I mean, I'm seeing a lot of investors are like that. Most of the time, people are happy getting cash flow, but people really don't understand the exact science behind investing, right? So it's very key as a passive investor for you to really learn the investment structure. And when I got to know that, I mean, I'm giving more education to wherever I go so that people understand. Every passive investors are able to read the PPM and discuss, right? So it's a very key thing. Yeah. It's probably my fourth book, which is another 2 more years from now. So I do have an online course where it's called Advanced Passive Investing, and the last chapter, it's online passive investing. If you go to passiveinvestinginrealestate.com, you'll get this course. If you go to even achieveacademy.net, achieve-academy.net, you'll see the course. I don't want to make it sounds like I'm trying to sell the course, but that's out of 7 chapters, that's the last chapter. I call it the dark secrets of industry, right, which talks about all these different structures. And there I visualize a lot of things, right? How do you do it per month, per year, and how's the right thing to do, and who benefits, right? Keep in mind, whenever somebody is giving back your capital, right? So on the calculation, on the back end, when they do a split 80-20, the sponsors are the one making more money, right? Assuming the market's going up, because your profit is only counted at the back end, correct? You're buying at this price, and you're buying at this price. Here you make zero, you're basically capital back. And then if the price is high like this, yeah, you make money. But if the price is like this, you make zero money. If your price is like this, nobody makes money, right? But this is, for any syndication, you don't make money. But even the market, but at least if it goes like this, and they paid 10% for 3 years, you still made 30% return, profit, right? Maybe your principal may not get the whole thing, but everybody was okay. Nobody really looks at the PPM because all the time prices were going up like this, right? For past 10 years, right? All of us, everybody's 10 years, right? Nobody invested more than 10 years. Right? So you have to go back and look at your PPM. And sometimes nobody knows all this until the return didn't come. And now we start look at the sponsor. Oh, this sponsor is not good. This syndicator is not good. He didn't return good money. Or the other sponsor returned like 3x. Sometimes and they bought the same time, right? But nobody talks about it, right? But you just take the money and leave, right? But if you look at the PPM, that's how they structure it, right? Yes, question.
When you say you're getting the capital back, so the capital is tied, right, on the property, on the investment?
Mm-hmm.
So how do we get the capital? The money is not.
Well, it's just, so capital is tight on the property, but the cash flow that's coming in, right? You can define that as a profit or you can define that as capital. Correct? It's just a definition on paper. Make sense? So the question, I think Mr. Rao was asking is, when you're giving principal or you're giving capital, your capital is paid down for equity, right? But what I'm saying, the question he has is like, when the cash flow comes in, how are they paying this 10%, right? They're not taking from capital. They're not going to the equity and taking back because purchase is already closed. But any profit can be defined on paper by something, right? You can say it's a capital or operational profit, right? And a lot of times this happens when it's a group think in a club, because when you join an investing club, sorry to say, a lot of people just follow the crowd, right? When you are professional investors going to different sponsors, I mean, most sponsors out there, they don't do that because they know they won't get investors, right? If you go to professional sponsors, I wouldn't say professional, everybody's professional. I would say that sponsors who are raising money outside of the clubs, they have to make sure they do the correct structure because investors can see. But in the club, everybody looks the same, everybody's structured the same. They say, oh, that guy did it, this guy did it. Everybody doing the same, what's wrong? Right? And sadly to say, that happens a lot in that kind of scenario, right? So, but as I said, 90% of the operators out there don't do that kind of structures because they know they won't get investors. They will lose out eventually. Yeah.
I need to understand this 70-30, 80-20 split. What does it mean?
It's a split between the GP and LP. Right? Let's say I'm a GP. Let's say, the deal sponsor. Let's say this guy takes 20% or 30%. The remaining profit goes to passive, right? That's how syndication is usually done, right? Where we split the profit and we tell them, hey, you gave me the money, you're a passive, I'm an active guy. Whatever profit we get, we split. So that's what it means by 70-30 or 80-20.
As you pointed out, it's a very important differentiation whether capital is returned before profit split or whether capital is returned as profit split.
Absolutely. It's very important, but as I said, many people give that education to a lot of people, right? So when I got to know, for me it's very straightforward. We give the 100% capital and we do a profit, right? When I got to know that, I said, that's a really good deal for GPs because instead of 20%, I'd probably be making 30%, right? Even though the PPM is 20%, indirectly just by changing one word, return of capital versus return on capital, one word, right? As I said, the PPM is so difficult to read, but just one word can change the entire deal. I can write everywhere 80-20, but I could probably be making 30 to 40%. So that's a really good deal, but I don't want to do it because for me, it's very important that nobody should feel like
You only get to do it once,
you only got to do once.
right? And then once you get one SEC complaint, it can destroy your business.
Well, it's very hard to complain too, right? Because they said that's how the PPM is written. You signed on it, right? I mean, what are you going to go to the SEC and say, right? The only thing that you can say is when they're presenting on the webinar, when they say 10% cash on cash, that's a fault. Because that's not really cash on cash, right? But there's a lot of people who does it. Even they do not know this. They go and say cash on cash, cash on cash, right?
Also, the SEC only comes after the fact.
After the fact.
So assets have already lost.
Already lost, yeah. I mean, you can complain, but it's already done, right? So that's why I think in 2019, I decided to write that book so that I can give education to passive, right? And people say, are you writing the book to raise money? I already raised $30 to $50 million even before writing the book. But I think it's very important for us to educate passive investors because they are the 95% of the real estate investors. Active people are only 5%, very small people, right? So yeah, questions?
So you showed us the different areas you are investing
Mm-hmm.
the channel
Mm-hmm.
you pick where you want or you
Oh, no. When you are passive, you just invest with whatever the sponsor is telling you, right? So there's two types of deals. One is called a single-purpose entity investment. We choose the deal, and we come and bring a webinar. We tell everyone this is the deal located in Austin, in this area, this is how many units, this is the returns. You want to invest, you invest. If you do not want to invest, you move on to the next deal. There's another type of deal where we call it a fund, where we tell you this is a high-level guideline. We're going to look at Austin, Dallas, San Antonio, Houston, 1980s to 1990s property. This is the high-level return. So then you invest into a fund, because that can be a group of properties, right? So there you believe more on this operator, because the operator is giving you a high-level guideline. So if the operator need to have very strong reputation, very strong track record to believe in him, right? It also reduces the risk as well, because now you have multiple. So there's two types of deals that you can do. Although we have never done a fund yet, maybe in the future, but I like to do one deal by one deal, because fund means I get the money and there's a lot of pressure to go buy deals. So we don't like to hold money, because when you have too much money, you tend to make the wrong decision of buying the wrong deals. I'd rather wait for the right deal and then raise the money. Yes, question?
Would funds be covered under the same, like, let's call it C structure?
Yeah.
C structure, or would you have to go into some other type?
No, there's funds, there's many types to do it. You can do Regulation B fund, or even Regulation A, or even you can do 506C as well. Yeah, you can do a 506C. Yeah, it's just a group of properties, and that's not a big deal. Yeah. So the question was whether funds are, which regulation is it, right? So it can be Regulation A, there's Regulation 506B or 506C. You can do either, any one of it. It's just the way different funds are structured are different. So the deal is very important as well. What is the deal? How good is the deal? Whether is there real upside on it? And whenever somebody is presenting webinar, they want the sponsor, the operator, whoever raising the money is going to tell you what is the upside. Why do they believe this is a good investment, right? And the prettiest deal may not be the best investment, right? Right, in HGTV and flip, the ugliest house makes the most money, right? Right? Or sometimes you focus on the cash flow, right? It depends on your life cycle of your life. If you're a young guy, you want to take more risk because you have full-time job coming in. You can go into a deal where you multiply the deal, multiply the money. You don't need cash flow, right? So don't believe when people talk about all the time cash flow. You may not need the cash flow. But if you're a senior, you need the money, you want to make sure your money that you have, you do not want to take risk with it, then you want to go for more cash flowing asset. Because cash flowing asset has less risk, right, compared to deep value adds and all that, right? So make sure you choose the right deal and the market also, right? You want to make sure you buy in the right market, right? Market that's growing. The good thing is every major market in Texas is growing. San Antonio, Austin, Dallas, Houston, and people are still moving in, so Texas is a really good market. And you want to see whether it's infill or somewhere suburban or rural. I mean, there's no multifamily or no commercial usually can be done rural, but it's not only multifamily, right? It's also dollar store. Let's say that somebody create a commercial real estate fund which focus a lot of dollar store. As long as the numbers looks correct in terms of cash flow, nothing wrong in investing, right? Main thing is the first two things. Operator, the investment structure is very important for any passive investors. Oh, so this is single family versus multifamily. So how many people invest in single family? Okay. So when I started single family. It took me 1 week to count why single family why multifamily is better than single family. It took me, because single family make a lot of money, 20-30%. It's your own deal, right? You get all the depreciation, you got all the income. But finally, I went to multifamily because of the fast appreciation that I can do on multifamily. So just a differentiation, single family is 1 to 4 units in Texas. If you go to Boston or New York, even 4 units, they call it multifamily, right? So there are 2 units they call multifamily. But here in Texas, 1 to 4 is all single family. Multifamily is more than 5. It has linear depreciation for single family, 27.5, but multifamily, you can be creative in terms of accelerated depreciation. Valuation for single family is based on comps, whereas multifamily is based on net operating income, right? So it's more like a business. Whereas loan type, here you get recourse loans a lot, and commercial you get non-recourse, especially on multifamily. There's a lot of non-recourse, 30 amortization. Management, for single family, I mean, you can give it to third-party property management, but you're going to be losing some money for that management fee. Whereas multifamily is professional property management, involvement of owners. If you're 100 in a single family, if you don't give it to third party, you have to be managed by yourself. If multifamily is passive, you don't really manage, you give it to the sponsor, right? Funding source, you can use cash. In a multifamily, is cash or IRA, right? So this gives you a lot of benefit, because IRA, you have to invest in someone else's deal. You can't invest into your own house, right? Whereas in multifamily, because you're investing in syndication, you can give it to an active syndicator.
I have a question.
Sure. Uh-huh.
Trust account,
Mhm.
you can buy investment property, right, individual home?
For yourself?
I'm not for renting.
For renting, right? But I don't know. I mean, I can ask the IRA guys, but I thought you can't invest into your own deals. You can?
Yeah, you just cannot do anything. You have to have management.
That's correct. If it's
Mhm.
an investment that you're involved with, your IRA personally cannot be involved. That's a direct kind of prohibited transaction, so you're disqualified for your IRA.
So if you can take your own IRA and invest into your own house?
Your own IRA invested into something else, but
Okay.
it can't be your house.
Yeah, so you can't be yours.
No, my question is, through a Quest Trust account, we are able to buy property, single home, I mean, one family home, and then rent it.
And then rent it.
So that comes under that capital, right?
Oh, okay, got it.
But all the work,
So when you said,
Or you can't be involved in the day-to-day operation.
you can't mow the grass, you can't paint the house.
Okay.
You can't do anything that would be sweat equity. All the work in that has to be passive.
Got it. I need to fix that slide then.
yeah,
Correct. No, I was under the impression that, since it's your own house, you basically have a direct connection, right? But looks like if you're not involved and all that, there's a way to work around it, I guess.
sir, I didn't know that we can't do any small repairs and all, we cannot do any.
Which one?
I'm done.
Oh, yes, he's asking.
So you cannot do any small repairs or something? No.
No,
You can't touch it.
if you do, IRS considers the whole thing to not be part of your IRA.
But how do they know? They're small repairs.
If you have a picture on Facebook, they will find out. IRS knows everything.
Big Brother's watching always.
No, you can do anything without people knowing, right? But if you get caught, then
Sister-in-law. IRS will find out.
yeah. Yes, sir.
I just wanted to say that, like, on our single family,
Mhm.
we have many people that we borrow money from that fund it through their self-directed IRA.
Got it. Yeah. So that's a fund to somebody else, right?
I find them, they're the best.
Yeah. So that's more like a JV or syndication where they are not involved.
Yeah, but they're a lender.
The lender, okay, got it.
Through their,
Oh, lending, okay, got it.
right, and 401, I like the 401k.
401k?
Yeah, there's so much.
Good, yeah, it's easier to take it out, yeah.
Love Quest too, because we got a lot of people that get this Quest all the time. So,
Got it.
love both.
Good, yeah. Yeah, I'm a Quest customer as well.
Yeah, 401k, yeah, no, you have to have your own self-directed. You have to take it.
I think solo 401k. Yeah, so I'm going to be talking about that in the next slides. So sources of fund to invest in CRA syndication can be cash, IRA, or solo 401k. So why invest with self-directed IRA, solo 401k? You ran out of cash, right? So why not? I don't have enough money in cash, right? So you have controllability of deal selection. You can select your fund manager, and more lucrative, right? So this is why you want to invest in syndication, right? Pref return of 9 to 10. This is a bit outdated. Right now, if you can get 6 to 8% is actually very good already, right? No upside, average 13, 15% IRR on usual multifamily deal. So this is why you want to invest, in commercial real estate syndication. Disadvantage, there are some things that you want to be aware when you're investing with a self-directed solo 401k. You still pay taxes on the leverage portion of the CRE deal or any multifamily deal. It's not like completely no tax.
Not with a 401k.
Not with a solo 401k, yeah. So I'm going to be talking about that, yes. Yeah, unless you use a solo 401k, right? So, it's missing CK. Subsequent process quick as compared to cash. Yearly paperwork. There's some yearly paperwork that you have to do. So please help your syndicators when you help. Please fill up the form. I have a lot of IRA investors. They just give me a blank form and go asking us to fill up. I always tell them, can you fill up something, at least your name, so I can at least fill up the rest, because usually we have to give the valuation every year, right? So this is a self-directed IRA investing process. If you can find this in my book as well, when there's a new deal that's come out, the deal sponsor will communicate to everyone, usually through a webinar, through email, and then you go and tell them that you give a soft commit on how much you want to invest, and whether you are accredited or not, depends on the deal. And also, usually the sponsor will tell who's in, who's waitlisted, who's out, right? Whenever you're oversubscribed and you want to know whether you are in the deal or not, right? So usually a lot of our deals get oversubscribed very quickly. So I usually have a communication say you are in, you are out, your wait list, where at least people know. Investors, so once they say they're in, they go and read all the PPM and send the docs to IRA custodian. And after that, the IRA custodian funds release the investment, and that money goes direct to the deal with the sponsor. So that's the process of using self-directed IRA to invest in syndication. How to compete with cash in best deals. If you have cash, be ready by setting up your self-directed IRA custodian account, right? Because you're competing with cash, right? So I'm giving you tips on, because sometimes people like, the sponsors, a lot of them like cash because it's quick, right? Whereas talking to self-directed IRA custodian and getting the paperwork, right? But if you want to compete with cash, quickly get ready with your self-directed IRA custodian account, send your paperwork custodian quickly. And if you have a solo 401k account, it's also very quick. Because solo 401k, you can write your own check and you can transfer yourself directly. Get funding quick by wire to the sponsor. Pre-fill yearly paperwork. Yeah, this is what I was talking about. No, pre-fill at least your name or your address or deal address before sent to the sponsor. So because the sponsor would love people who are easy to work with. Self-directed versus solo 401k. So solo 401k is, you can avoid UBIT, which is basically the tax on the leverage part. So any multifamily syndication or any syndication, they have leveraged loan part and they also have the cash part, right? Equity part. If you do a self-directed IRA, you're going to be charged, even though you make a lot of money, you make 2x of your money, right? But 2x times 80% or 75% of your whatever loan that you take, that part's still being taxed. It's not fully not taxed, right? But if you do a solo 401k, there's a way they can avoid that. Solo 401k have higher contribution limit. I actually set up solo 401k with Quest as well. It's as liquid as cash, wins deals. It also needs self-employment income. So that's, you have to talk to someone who's specialized in that. Also allows tax-free loan option. Need tight monitoring to ensure no violation to IRA rules. I mean, since you're managing your own solo 401k, you have to make sure you don't violate any IRA rules. Right? For example, mowing your lawn. Right? So nobody knows until you get caught, right? So why care about taxes? When I started my engineering job, right, I never really looked at tax, right? Because at the end of the day, you just want to see how much money is going to take home, right? So every account, just how much money I just budgeted. I know that tax being taken off. Until I saw this table. If you see this table, $1, right, compounding tax-free and taxable at 25%. If it's tax-free, the $2 that you have every year compounding, it becomes 1 million in 20 years. But if that $2 you're paying 25% every year, that first $2 become 175, it become only 72,000 in 20 years. So now I'm start looking, oh my God, I need to look at taxes, right? I mean, I don't know, I'm sure a lot of my colleagues, when you're working W2 full-time, you never really look at taxes. We're so busy working, right? So, but when I see this table, that's a lot of money, right? So I'm done with my presentation. Let's go to Q&A. If you want to invest with us, you can scan the QR code. It goes to our website. To get the book, also the other way to get the book, but it takes like 3 or 4 weeks, is go to passiveinvestingrealestate.com. You can get the book as well, but you have to pay like $4.95 shipping and handling. But as I said, this will take like 3 or 4 weeks from now to get the book. Any questions?
So we don't have any questions online. Luckily, we have a moderator, so they were answering the questions there. But for those in the office today, do we have any questions? All right, I'm going to run the mic back here so those that are online can hear it as well.
What's the biggest pro to this lifestyle, and what's the biggest con to this lifestyle?
Are you talking about lifestyle and passive investing? Oh, yeah. As I said, active, you get a lot of gray hair, wrinkles, and because it's a lot of work, a lot of stress too. And, active, you have to be skilled in real estate. Not everyone can be active investor, right? And you also have to see your own risk tolerance, because it sounds very cool. You're getting GP sheep, you're making millions of dollars, but you want to see your risk tolerance. Are you a business person? Are you an entrepreneur where you're able to make decision quick? You're willing to risk your family's income by going and doing a business, right? If you're not, then you rather just do passive investing and focus on what you're passionate about in your whatever job that you're doing or whatever business you're doing, right? Because you want to be, not, as I said, not everyone can be active because it involves a lot of risk, a lot of stress, a lot of knowledge as well in real estate, right? There's a lot of knowledge there. You have to know loans, you have to know market cycle, you have to know how to turn around property, you have to know how to manage contractors, right? Whereas passive is a beautiful thing. As I said, you put the money, you choose, but of course you have to choose the right sponsor, you have to choose the right investment structure.
That's where all the risk is discerning who is that right.
Who is the right guy?
be.
Correct.
Because it's, when you're doing your own stuff actively, then it's all on you, how you manage your property.
Mhm.
But just like with single family, I have some property that's far away, and I tried to get a property manager, and that ended up being very risky.
Correct, because they're managing for you, right? So,
Yes.
or you have to drive there and see, right? So it's a lot of work and a lot of risk. Yes. Question.
So I'm curious if you yourself plan to move to the passive only side at some point, or are you going to stick with being active?
That's a really good question. So, my third book, right? So the first book is Passive Investing in Commercial Real Estate. The second book is I wrote the book for doctors. Let me just show that. So this is the first book, right? Everybody knows this. This is a newly launched book. It's only like 2 months since we launched it, right? Smarter Doctors. You work hard, make your money work harder. We wrote the book for the doctors because I think they need some help because there was so much of financial advice bombardment. But my third book is called Breakout. Breakout basically talks about life cycle of someone from passive to creating a legacy. So at some point, yes, there will be a lot more passive. And the last point before you create a legacy is what I call where you start buying deals on your own, where you start owning the whole thing. The whole real estate is yours. But this is large real estate, more than 100 units. So we are more into that right now because we have like 170 units that we own ourselves. We are building 320-something units that are owned by ourselves as well. So we are going more into that, which also become passive at that some point, right? But in between, there's a lot of steps. You become a GP, you become money raiser, you become passive. So I've outlined the steps for everyone to follow. So that's my third book. It's being co-written with Robert Allen. Who knows Robert Allen? Yeah, Robert Allen, yes. So he's my co-author there. But it's going to be a very interesting book because that talks about the questions like this. What's the exit plan? If you're passive, what's your exit plan? Right? If you're active, what's your exit plan? Because a lot of people don't even think about what is the exit plan, right? So that book is going to be answering that question. Yes. The question is, if it's cash transaction, what is the minimum you can invest in syndication, right? You're talking about? So yeah, it depends on the deal, right? So usually 75,000 to 100,000 is very common. And there are some deals which says 50,000 is common. There are some deals which say 25,000 is enough. And depends on the deal by deal. So during when a syndicator or sponsor present their deal, they'll say this is our minimum, right? In our deals, usually it's like 100,000. And we have been recently doing a lot of 506C, which is basically only accredited investors, right? But we don't bring a lot of deals out because we're being very careful with our deals. So it gets oversubscribed very quickly. So, but be in our email list and just be watching what deals we bring. Yep. Any other question? Yes.
So now that interest rates, I saw on commercial mortgages last I checked. Basically, my question is about the interest rates. Now that they're over 6%, completely different from what they were before COVID. How has that changed your strategies, your focus, whether it's the asset type, or do you shift more towards ground development, the loan to value ratios, all that stuff?
You want to know the secret? So the question is basically, with the interest rate going up high, how does our strategy have changed? So we are not buying a lot of existing asset right now. I mean, we have recently, for past 3 years, we only bought like two deals. Past 2 years, we bought 2 deals. That's it. We didn't do a lot of deals, but they were really good deals, so I want to do it. We have started ground up construction, that's going on, but we are focusing a lot on land entitlement right now. Right, so the idea is to do a lot of land entitlement now. When the interest rate drops, now we can start doing construction. Because land entitlement doesn't need interest rates, because it's all under contract, right? But while we're under contract, we're doing land entitlement. We work with the government entities. So there's no investors, there's no money to be raised, there's no interest rates. We are basically working with the government entities to increase the value of the land. So we are doing a lot more on that kind of deals right now. Even though I want to look for some deals now because I know there's some distressed deals coming. But we are focused a lot more on land entitlement deals.
And then I had a second question. Just
Sure.
what's the typical compensation structure for the GPs in these syndications?
Usually it's 70-30, 70% to the LPs, 30% to the GPs, after the principal's paid, on top of it, profit, right? So that's very common, and there's of course there's some acquisition fees, some I mean, I outlined all the different fees in the book. Acquisition fees, sometimes there's refinance fees, there's exit fees, there are a lot of fees. So you as a passive investor, you really have to read the PPM and see whether you're comfortable with it or not, right? So that's the key thing. Read the PPM and understand the investment structure very well. So PPM is actually, it's actually a prospectus given by the attorney from the sponsor to the investors, so they can read. But it's very legal language, mumbo jumbo, right? So not written in plain English, unless I explain it in plain English. You can't even go to another lawyer because he's going to read it the same way.
It's long.
It's long. Oh, yeah, it's like 100 over pages, 120 pages, right? But there's few key aspects of PPM that you just have to read. You don't read the whole thing. Read the investment structure part. That's the most important in PPM. Because everything else, they would have covered it during webinar. Yes?
Is it GPs or legal offices preparing for some condo? Like what's the, because I've seen like a lot of different kinds and I actually just don't know. Yeah, like who prepares the PPM and how regulated is it in terms of what it needs to include versus not?
So the question is who prepares the PPM and how regulated is it, right? So the attorneys prepares the PPM based on the GP's direction. The GP said, this is how I'm structuring my deals. The attorneys will prepare as what they want. So it's of course, attorney is a licensed attorney, right? So they do it correctly as whatever it is. The passive investors are the one who have to read and understand whether they want to do the deal based on that. So it's very well regulated, but it's all based on, there's no industry regulation because everybody can structure their deal differently, right? This is capitalism, right? Everybody can do whatever they want. It's like Shark Tank, you go to present a deal to Shark Tank, you can structure the deal many ways, right? So, yes.
I would just piggyback and say that, like, on our deals, we hire SEC attorneys to draft it. We directly say, here's what our structure is, and then they draft it up.
And you're doing it on it's deal by deal, right?
Yeah, absolutely.
Yep. Yes. Yeah, the SEC attorney prepares it. Yep. Any other questions?
We actually do. It's online. I'm grabbing it 1 second.
Okay, online question. Good, at least I know someone's watching me.
Let me see if I can run back and grab it myself from back here.
Makes me wonder if you could take the PPM.
Okay.
Oh, GPT, yeah.
Okay, so I know you can't I know you can't see me, but this is the question.
Sure.
It is, what are your thoughts on crowdfunding for commercial real estate?
Good. So the question is, what do I think about crowdfunding? There's nothing wrong about crowdfunding. I wrote in the book as well the 3 types. One is the syndication, one is the JV, and the other one is crowdfunding. So you definitely take that book and read because I explained that more. Nothing wrong in crowdfunding. It's just crowdfunding, you're throwing money into the cloud, right? I mean, hoping somebody there, behind there, does a good job with your money, right? Syndication, you know who are you investing with. You know who's the fund manager, right? I mean, same thing with REITs. People ask, what about REIT? Why not invest in REITs? REITs also, it's like stock market. You give the money and then you hope someone is doing a good job. You get like 6-7%. I mean, usually it's lower return than normal syndication. It's just different ways. So whichever you're comfortable with, just go with what you are. What do you think you're comfortable with? But syndication for me is like, who's the sponsor you're investing. You build a relationship with that person. If they keep on doing the good job, you're going to keep on investing with them. That's good. Any other questions online? They're good. Any other questions? Thank you so much
All right.
for coming in. Hope I added a lot of value to all of you.
Thank you, guys. Alrighty, feel free to stick around, network if you want to hang out, grab a couple more slices of pizza before it's all gone.
Yeah.
And we will see you at the Self-Directed IRA Social at 6:30 here in the office next Tuesday if you want to come out and network with us again. A little bit of a bigger crowd since some of those daytime people, they can't make it for the day. They'll come at night. So we would love to see you. Thank you so much.
Good. You're welcome. Microphone.